Hey, it's Justin Harvey. Thanks for tuning into the Anesthesia and Pain Management Success podcast. With APM Success, we take a close look at important topics pertaining to business, practice management, personal finance, and careers for anesthesiologists and pain management physicians. We work hard to take your critical questions straight to the experts. Thanks for listening. Hello and welcome to episode 153 of APM Success. This week, we're going back into the archives again to revisit one of the more interesting conversations that I've had, in my opinion, in the illustrious history of the podcast. I talked to Larry Elisco, he's a CPA working in a tax group at Wipfli, specializing in healthcare, and has a lot of experience in healthcare valuation and succession planning for physicians who want to sell their practices. I learned an immense amount in this conversation about the differences between an internal succession, meaning I'm selling to a junior physician partner, versus selling to a hospital versus selling to a bigger pain group or private equity-backed group. The dynamics of the deal, the amount of money that you get, the way that your job description looks upon sale, vary widely based on who you're selling to. So the goals around your practice transition really are going to go a long way to determine who the right fit is in terms of buyer. So because this is one of these things that keeps popping up in the last few weeks, I find myself having a lot of conversations about physician practice succession, specifically doctors who want to sell their practices and transition significantly, curtailing their employment or moving from I'm a business owner to now I'm just an employee and I want to start moving towards retirement type of model. This episode has many, many great insights, and special thanks to Larry for lending his expertise, and hope you enjoyed this episode of APM Success. Hello and welcome to episode 106 of APM Success. I'm really pleased to be joined today by our special guest, Larry Elisco. Larry is a partner at Wipfli, which is a national accounting, tax, and consulting firm. He has specific expertise in valuation for physician practices, compensation arrangements, unique tax considerations, and much more. He brings decades of experience to this conversation. Larry, thank you for being here.
Well, thank you, Justin. I appreciate you having me. Looking forward to chatting.
Yeah, we spoke to your colleague, Jim Giese, a couple of weeks ago. We were talking about tax considerations for ASC owners. Today, we're going to talk about another phase in the life cycle of practice ownership, which is the exit from practice ownership, or beginning to land the plane on a potential exit.
Right.
So there's obviously a number of ways that exit can happen. So maybe put yourself in the shoes of one of your clients who's later in their career and beginning to think about what does it look like to start to take a step back from medicine as a practice owning. And in this case, we're talking specifically about pain management because it has its own flavor. What types of questions should a physician begin to ask in those circumstances?
Well, I think one of the first things would be why would I want to go with private equity as opposed to trying to go another route in order to create a liquidity event for my practice.
Yeah.
Quite often physicians have, at least historically, have relied on bringing partners in or selling to a hospital. Those are certainly still possibilities, but selling to a hospital generally can be limited as far as the value you're going to receive for your practice. It's very, driven towards compensation as a way of creating a liquidity event. And hospitals are limited in their ability to value a practice and include goodwill, which we can certainly talk about when they are able to purchase a practice. If you're, fortunate enough to have a partner or an associate that you would make a partner, or a number of associates that are interested in buying in, that's also a very good option. Again, your valuation is going to kind of be a little lower. You're not going to be able to get the type of valuation you get from a private equity firm when you bring partners in. And quite often, partners are really not that interested in being entrepreneurs and owning a practice, and certainly not interested in paying for it. They're in many cases very happy to be earning what they're earning and they don't want the headaches, and they don't want to have to buy in and then have to worry about who they're ultimately going to sell to.
Yeah.
So it's become less and less prevalent, I think, in the marketplace in general with physicians, bringing partners in that are going to buy you out as an exit.
Got it.
So that kind of leaves private equity, which in the last 10 or 15 years has become much more prevalent.
Got
And
it.
it really provides an exit that'll provide an immediate liquidity event when that takes place. So that really, is quite often the best solution in the physician's mind. Going private equity, I want to work for the next 3 to 5 years, and then I want to retire, and I want to get a big check up front. I also may want to get some stock in the PE firm, in order to really kind of capitalize on their initiatives.
Okay, so that's really helpful context, Larry. So just to briefly sort of describe the three different options as you just laid them out, we have a private equity exit, we have a hospital acquisition exit, and we have what I'll call like an internal succession plan to other physician partners exit. And I think as I just described them, we can sort of, would you put them in descending order as I just described them in terms of um, like the amount of money you can get for your, obviously there's a lot of complexity around like, what does it mean for your job? What does it mean for the future of your practice? But if we just look at the numbers for a moment and say, how am I going to get the most bang for my buck with the asset that I've built that is my practice? You're saying the private equity exit makes the most economic sense. Is that accurate?
I would say that's accurate. The private equity firm, number one, aside from the hospital, or as opposed to the hospital, can really pay for goodwill. They do that in the way that they structure their deals. However, hospitals have to pay for goodwill that's specifically identified, like a workforce in place, or what the cost would be to bring up the same, uh, you know starting a practice, buying a lease, doing all those things. The hospital can assign goodwill for that, but it's got to be very specific, and it's very limited. Kind of the same with a physician, that partner that you're bringing in. They need to be they need to pay some goodwill, but they look at a lot of their goodwill as their own goodwill. They're buying their own
Right.
goodwill because they're the ones that are providing the services. They've provided the services. They've built up the value of the practice. So in many cases, they don't want to buy their own goodwill. So private equity is clearly the best option from an economic perspective.
And to be clear, goodwill for our listeners who are uninitiated into the realm of finance is, I would describe it as like the delta between the book value, the value of all the assets that your practice has, and what you can sort of get for your practice on the open market. How do you define it as a
That's a great
valuations
way to
expert?
that's a great way to look at it, the economics of goodwill. It is the difference between not necessarily the book value, but the fair market value of your assets, and
Yeah.
really what you really have when you have the assets of a physician practice. It's typically some equipment. You may have some software, but generally the fair market value is pretty limited. And then anything over and above that is really considered goodwill, difference between the purchase price and the fair market value of those assets.
Yeah.
Goodwill, I would look at and say there's kind of two components to goodwill. There's what I would consider personal goodwill, which is the value and the reputation of the physician themselves. So if you go somewhere and somebody is a world famous transplant surgeon, for example, that goodwill would go with him or her, he or she, as opposed to the practice itself. Whereas if you look at McDonald's, for example, wherever you go to McDonald's, you're going to pretty much get the same product, whether you like it or not. And that is what I would consider enterprise goodwill. So there's two components to it. In the case of physician practices, and with in regards to the difference between the purchase price and the fair market value of the assets, which we're considering goodwill, there really isn't that much of a distinction with that. There's some tax considerations to it, but rather than getting into the weeds on that, we could just say that that's how goodwill would be viewed.
So as a practice owning physician, essentially what you're doing, the specific asset that you're selling that is the most valuable component of this exchange is the goodwill that you've built through your practice over the years. Is that fair to say?
That's fair to say, and it's also, how it's viewed by the buyer. So the
Right.
buyer looks at you and as a physician practice and says, I'm going to value you, but I know that in 4 or 5 years I can sell. This is the PE buyer.
Right.
I can sell your practice for a much greater value in 4 or 5 years. And after I build up your practice and aggregate other practices with you and generate economies of scale, better billing and reimbursement, uh, and basically managing the practice in a more effective way, and then packaging those groups of practices and ultimately selling in 4 to 5 years. So that's where kind of the economics are in the private equity side, and that's where all the goodwill kind of comes from.
That's a great point. So let's talk about this for a second. The intent of the buyer, what they're going to do with the practice influences how much they're willing to pay for it because it also influences how much money they're going to be able to make with the thing that they buy. So I think the way you just described this, it explains the difference. Well, it explains the hierarchy, right? The hierarchy of PE and then hospital and then internal succession, if we assume for a moment that that is the proper configuration. The private equity strategy associated with the acquisition of a practice, I would say probably what they're going to do is gradually transfer that personal goodwill, turn it into enterprise goodwill, take it from like Dr. Smith, MD, and how much he's
That's a good
beloved
way of
in the
looking at it.
community, to take it
Right.
to, you know, Dr. Smith and Associates, and then we really, over time, transfer that goodwill to the associates, and then there's another opportunity to, monetize that enterprise goodwill at a greater multiple, perhaps. So that strategy that a private equity firm would use is different, perhaps, than the way a hospital would monetize that same practice. Would you say?
100% agree. That's a great way of putting it because you really have a practice that is generally personal goodwill with the physicians. There may be a name if you have like a large organization that owns a lot of practices. Maybe that name means something, but in general, it's the physician that has the personal goodwill. You're really kind of converting that from personal goodwill to enterprise goodwill, and the PE firm is basically creating a market for your practice. The market for your practice is limited unless you go with a PE firm that has a strategy that will create value for you and then also create value for them down the road. And I'm simplifying it because the process is a little more involved
Sure.
than I'm describing, but that is the essence of the economics.
Yeah. So maybe for just a moment, describe the how this would work in a hospital-based setting, and like why is the hospital handcuffed a little bit in terms of how they value goodwill?
Sure. So hospitals are not allowed to buy referrals under the federal Stark and anti-kickback rules. They are not allowed to say, okay, I'm going to buy goodwill that is undefined. So if it's again kind of the workforce, the value of your charts, these are things that can be quantified, and it enables the hospital to buy goodwill in addition to the fair market value of your assets. But that's very limiting considering that, if you're a PE firm, you're looking at, what we would call earnings or EBITDA and applying a multiple to that. That's going to be significantly more than what a hospital can pay. But because the hospital cannot buy referrals and it's viewed by paying for goodwill that's undefined, it's viewed as buying referrals. So that's why they're handcuffed. Now, they could, again, make up for it from a compensation perspective down the road, pay a signing bonus or a retention bonus. And again, of course, it's taxed as ordinary income as opposed to goodwill, which is taxed at capital gains rates. So there's clearly disadvantages economically to selling to a hospital, unless there's a true opportunity for you to be compensated as a physician significantly more because of their contracts and because of their leverage and because of what they can provide to you in referrals. But it's still difficult. You're still working. You're getting paid for your services, and there's only so many hours in the day. So,
Yeah.
being paid handsomely isn't necessarily going to substitute for the ability to sell the practice.
Right. And if we take that same question, understanding from the buyer standpoint how they're going to monetize their purchase, and we apply it then to the internal partnership succession. Like I've got two associates and I'm going to sell my practice to them. Similarly, they're going to be pricing their offer is going to be discounted because they don't have the same plans that the PE firm does of like scale, infrastructure, being able to take that personal goodwill, transfer it to enterprise goodwill, and experience the same pop. They're basically just trying to keep their jobs. So the way that they're bringing their offer to the table is going to be constrained. Would you say?
Right, right. And Justin, it's also there are economics involved, and when you look at like an associate that's worked for you for 3 to 4 years and has created their level of collections, they've created their reputation, they've created their personal goodwill.
Right.
You are then asking them to buy your personal goodwill in the form of a buyout, and there's a valuation formula in that, and it doesn't have the same constraints that a hospital would have. You can pay goodwill when you're buying in, but quite often that's going to be significantly less than what you'd be able to generate from a private equity firm.
Yeah.
Plus, the other component to this is that when somebody buys in, even though they may not be buying 100% of the practice, you then have governance issues and you have control issues. And
Yeah.
those really, are not always thought of by the physician that's the 100% owner of the practice. Wow, I'm going to have to give up some control here.
Yeah.
And uh, they will, that is often the point of contention when these deals take place, and it's very expensive too. You're dealing with paying your accountants, your lawyers, their accountants, their lawyers. It gets to be pretty costly,
Sure.
and if you don't have an existing platform for partners buying in, then that can also be costly. So these are things that you have to think about
Yep.
when you want to admit partners, assuming that the partners want to be admitted and they want to pay for that interest.
Right.
So
Another
it's
challenge with
challenging.
another challenge with selling to a partner is they either need to cut a check from their own independent wealth, or they need to get a loan from a bank, or they're going to do some sort of seller financed deal where they're taking a loan from the practice and using the profits of the practice to continue to pay the seller, which
That's a
has
great point.
its own like
That's a great point.
complexities. And
Right. You
if the new physician
right.
runs the practice into the ground after they buy it, then the seller they don't get the money that they are due, which can be
Exactly.
problematic.
The profits of the practice are generally used to buy in. At least part of the profits of the practice are generally used to buy in. And quite often physicians will say, "Why am I doing this? I'm just I'm giving you this partnership interest by saying, okay, you were paid X number of dollars before. Now that you're a partner, you're going to get money from our ancillary business and you're going to
Right.
use that to pay me. So what am I really doing other than just kind of shifting money around in the practice that I would normally be entitled to? I'm effectively giving you, at least partially giving you, this partnership interest. So where's the economic benefit for me in that?
Sure. Setting aside for a moment sort of the a desire that a physician might have to sort of keep it in the family, so to speak, and to give your partners an opportunity to continue to maintain autonomy. Let's assume for a moment that a physician who says, you know what, I'm ready to hang up the cleats in a few years. I don't want to deal with the drama of the internal succession. The hospital route has its own challenges, and so private equity is the way that I want to go. Um, Describe, if somebody comes in and sits down in your office and says, Larry, I'm 5 years out. I want to start, doing the window dressing, so to speak. I want to start putting the pieces in place, doing the due diligence to make my practice grow in the right ways so that I can have a smooth landing for an optimal valuation in a PE deal. What types of questions are you starting to ask them?
Well, number one, what is your ultimate exit? And are you willing, number one, if your ultimate exit is 3 to 5 years, that's great. If you want to retire in a year and for whatever reason, hopefully not health reasons, but just in general,
Yeah.
had enough and you want to retire in a year, that's most likely not going to be a good fit. The PE firm that's going to acquire you would want you to continue. They're going to have you sign an employment agreement that will require, to me, minimum of 3, most likely 5 years, so that you can transition your patient base to either another physician they bring in, or a mid-level, or whatever their plan is. They need you there to make sure that their patients are comfortable with the new environment, so to speak.
Yeah.
So that's one of the first points. One of the second point would be, are you willing to forego compensation in order to make this happen? So, as an example, I had a practice that I worked with where the physician was getting paid $1,800,000 a year out of their practice. Very successful practice, obviously. And they sold to a PE firm that said, we're going to guarantee you $800,000 a year, plus some incentives and plus some ways to make some of that $1,800,000 back, but you're not going to hit $1,800,000. However, the difference between the $1,800,000 and that 800,000 creates earnings, and the
Right.
earnings are used to value the practice, and that those earnings are then applied to a multiple that the physician or that the PE firm is willing to pay for that practice. Typically, that multiple could be anywhere from 5 to 6. And, and then that multiple creates a $6 million purchase price.
Right.
However, for the next 3 to 5 years, the physician is losing $1 million of compensation effectively, but they don't care necessarily because they want an exit. It's more tax advantageous to do it this way. So you, as a physician, have to be willing to understand, number one, you're going to take a big reduction in compensation in order to create value for the practice. Number two, you're going to have to answer to the PE firm and practice the way that they want you to practice. And not that they necessarily tell you how to practice medicine, but they certainly put things in your mind or let you know that it's not the same as when you called the shots before.
Yeah.
So you're going to have to follow suit with the way they want you to do things. You may have issues because it constrains you from practicing the way that you want. You're suddenly introduced to mid-levels you may not have had before. You're introduced to a new system. It's not an easy process. You pay the price in compensation, and as well as perhaps your mindset and some of the things that you have to go through in order to be part of a PE firm.
Yeah. You bring up some great points. And the one I want to point out first is I basically described an optimal scenario, which is 5 years from now, I want to be done. In
Right.
reality, that's a really nice, long timeline. And it's impossible to start planning too early for this, I would say. The shorter the time frame, the less options you have and the less flexibility you have in terms of this deal. So a private equity firm, if you come to them and say, hey, 12 months, I want to be out, the transference of that personal goodwill to the enterprise goodwill many times takes a lot longer than a year. And the
Absolutely.
private
Right.
equity firm wants to protect their investment. So they're not going to give you top dollar. They might give you a big haircut on that 5 to 6 multiple you described in order to give you the timeline you're looking for. And there's going to be trade-offs. So that's an important dynamic to be aware of.
Yeah, I think they would probably, in most cases, they won't agree to that.
Sure. Right.
Private equity firms have people that go out and are the business development folks. They kind of find opportunities. They try to close the deals, but typically they have they have a board that they have to answer to. That
Yeah.
really is their investor board. That's where the money comes from.
Yeah.
And if they present a 1 year exit, my guess is that most boards wouldn't agree to that.
Yeah. One thing that I've
So
found really fascinating about my vocation is understanding how incentive drives outcomes. So, obviously, the more you can align your incentives with that of the PE firm or whoever you're selling to, the more you can create a win-win all the way around. So, talk for a minute about the way these deals are structured in terms of, if I'm a 100% owner, or maybe I'm a 75% owner and I've got a couple of junior partners who are willing to go along. How much of my 75% am I going to sell? And is it usually like a full sale that happens over time, or is it like a partial where maybe we give another that PE firm, we give them a controlling interest, but we maintain a portion, and maybe they want us actually to make, they're not willing to buy 100%. They only want to buy 51%. And then they want to keep us wanting to grow the value that we continue to hold to keep us engaged and working. So what can you describe a couple of the different ways you've seen
Yeah,
this structured?
it's a great question. So typically, the PE firm wants to own 100%, and they're not going to be willing to put themselves in a position where they have to deal with a minority shareholder. Now, in some cases, there may be, options where you're so valuable and you have such a large organization that a PE firm would be willing to come in and take a minority interest. But I think for most practices, they want to own 100% because that, don't forget, in 4 to 5 years, they want to sell to a bigger PE firm and they don't want to have partial interests in these practices. They want to have complete control and they want to own 100% of them. So typically what ends up happening is that the firm will come in, they'll value your practice, you'll provide them with a lot of information even before what we call due diligence.
Mm-hmm.
They'll give you a letter of intent that says, here's what we think, here's the way this is going to work, here's the purchase price, and here are the terms. You're going to have an employment agreement. And it's not a binding document, but it pretty much says, hey, if you agree to this, then the next step is that we're going to have, the actual documents prepared that will be binding, typically an operating agreement and an employment agreement. The structure of these, because of the corporate practice of medicine, becomes complex.
Yeah.
So typically a physician that owns maybe a C Corp or an S Corp or maybe a single member LLC, it's a pretty simple structure. In order for the PE firm to own and generate economics from that practice, that's where the complexities arise. There's something called a management service organization that is generally owned uh, by a PE firm. It's typically an LLC, and it basically will generate management fees from the entity that the physician owned previously. And that entity will bill the way it is always billed because it's FEIN is what drives the billing. So that entity stays intact for the most part, still owned by the physician, but the physician then agrees to, for lack of a better term, shift any excess profits. In other words, any collections minus the physician's salary creates excess profits that gets shifted to the management services organization in the form of a management fee. That is really where the value of this PE group is established in this
Yeah.
MSO. They can own the MSO, even though they're not physicians. And typically, when the deal is structured, the physician will be paid based on the valuation of their practice, around 75 or 80% cash, 20 to 25% will be stock in the MSO. And it gives the physician the ability to continue to capitalize on the initiatives of the PE firm and the success of their practice. In other words, if the PE firm comes in and says, "Hey, we're going to do this, this, and this. We're going to really increase your collections. We're going to run your practice much more efficiently. You now have created this value after you've sold, and this is a way that you can stay on and still make money from the sale of your practice. Ultimately, when that MSO is sold, or in some cases with really big PE firms, they hold and they have a sponsor that will buy the stock or buy the ownership in the MSO by the physician down the line. They'll give them an opportunity for a liquidity event should they want that before the MSO is ultimately sold to another party. So I know that's a lot of information, but hopefully that was somewhat understandable.
Yeah, very helpful background. I recently saw there's a really great video. So Dr. Eric Bricker He's a guy, he has this organization called A Healthcare Z, which is educational, intended to help people understand all the mechanics of how the healthcare ecosystem functions. And he just did a great video the other day about corporate ownership of medicine and basically how it works and what are the legal infrastructure in place in order to make this function properly. And he did a great explanatory video. We'll link to it in the show notes. So if you go to apmsuccess/106, you can check out that video if you want to have more information in addition to that great explanation from Larry. Understanding that MSO dynamic, I think, is really important. And even having an ownership stake in that MSO is an important economic piece of this puzzle that you're going to want to get your brain wrapped around, because
Yeah,
there's a lot of value
it's
there.
interesting. Yeah, it's interesting because quite often I'll be dealing with clients that are selling, and their point is, "Hey, I just want the cash.
Yeah.
I just want 100% cash." And most PE firms are not willing to do that. And it's also not necessarily the most effective way of selling your practice,
Right.
because you really can be giving up a significant amount of upside by owning that MSO. But the other side of it is that the PE firm wants you to take this stock. That's the deal,
Yeah.
because they are looking to have you continue with some skin in the game. They want
Yeah.
you to have a commitment to this practice. They don't want to just write you a check and then you start taking all your deferred vacation, and all of a sudden even though you're not getting paid what you were being paid before, you're good because you're set. And that's one of the things that they're trying to avoid. But yeah, it's one of the other things to consider too, is that when you're creating this type of structure, your your cash obviously is taxable to you when you receive it, but the stock, or the ownership in that MSO, I should say, you should be able to roll that over on a tax deferred basis if it's structured properly.
That's a great
And
segue. Let's pause there because I want to zoom in on the taxation of this transaction. So
sure,
to keep things simple, I'm 100% equity owner in my entity, Dr. Smith Practice LLC. And I'm selling this entity to a private equity group who wants to buy me out in the structure that we just described. So talk about the tax treatment and the different ways to structure this deal and what it means for me in terms of
sure.
the tax bill.
So let's just use some hypothetical numbers. Let's say the practice is worth $5 million to the PE firm, and they've done their valuation, and this is the number that they've arrived at, and they're going to give you 80% cash and 20% stock. And when I say stock, I mean ownership in the MSO. So the cash is paid to you. Perhaps there's of that 4 million that's being paid to you, maybe 3 million is a check at closing, and 1 million is based on some holdbacks and some contingencies. Particularly with COVID, these deals are still taking place, but the PE firm wants to make sure that you're going to get back to where you were pre-COVID, so they have certain holdbacks and contingencies where you have to kind of reach certain levels in order to get that extra $1 million for the difference between the 4 and the 3 million. But as you receive it, it becomes taxable. So when you get the cash, it's taxable. It's typically taxed for the most part at capital gains, but because they're buying your assets, some of that will be subject to ordinary income depending on how much depreciation you've taken on your assets. So for the most part, it's capital gain. Some of it's going to be ordinary. So plan, at least under current tax rates, of paying anywhere from 25, maybe 28% tax for federal purposes. State, it's up to your individual state on that money. Then you have the stock, or the MSO LLC interest that you're receiving, and if it's done properly, that those interests can be rolled over, and you don't pay tax on those until you sell your MSO interest, either selling it to the existing owner or selling it more likely in a subsequent transaction. So that $1 million also will be taxed at capital gains rates for the value, and whatever the difference is between what you ultimately receive for those MSO shares and what your what that also all becomes capital gain, because typically that $1 million of value that you're receiving, will have no basis to you. In other words, the $1 million that you're getting is deferred, but you're not going to pay tax on that $1 million plus the additional proceeds until the MSO shares are sold.
Got it. Now, this $1 million piece, the MSO piece, if that is for like a new MSO that we're creating for the purpose of buying Dr. Smith Practice LLC, I'm curious how do I know that these shares of this entity that we just made is worth $1 million?
You don't. And if you are doing this, there's some advantages to getting in on the ground floor, so to speak, but there's also disadvantages because of the risk. So there is risk that that $1 million is going to be worthless at some point if the PE firm doesn't succeed. So you have to do your due diligence. You have to know what their plan is. You have to know why, kind of where they see your practice fitting in with all the other practices that they're acquiring. And you need to have a full understanding of their background and what their ultimate plan is and what they've done in the past. Typically, the folks that you're talking to have had a success story in the past, at least one or two, and they're doing something now that is similar to what they've done in the past. So you can look to their track record for that. In many cases, though, you're also getting in on the ground floor, and if you have someone that has done this before, and you're the first, you're the first one, one that they're acquiring, then you have the benefit of hopefully getting a lot of accretion, a lot of appreciation on those MSO interests, because you should be getting kind of the biggest bang for your buck by agreeing to accept these shares. So maybe you're getting 10% of the MSO, and the next person that buys in gets 5% if you're against looking at the values being the same, because you're the first one in, and they
Right.
should be willing to pay you more in the form of appreciate of MSO interests. As far as they're again, they may be an established MSO as well, which makes things a little different.
Right.
But generally, I think that you have to kind of weigh the the benefits with it, and many physicians say, look, I'm okay with getting the $4 million. If I just get the $4 million and I get this stock and nothing ever happens with it, I'm good. I'm set. I've got the money I wanted, and this other $1 million is somewhat on the come, and it may not happen. So
Right.
that's the way many physicians look at it. It's not a bad way of looking at it, particularly if you're not paying tax on that additional $1 million until it's sold. You don't want to be in a position where you're on the ground floor and you're paying tax on those MSO shares based on some valuation that has been arrived at, and that's where you can kind of have issues.
Yeah. Yeah, that makes a lot of sense. How long does this take from the time that I walk into your office and say, I want to be out in 5 years, to the time that I've got my ink on the contract with a group that wants to acquire my practice?
Well, I think that you'll find that the PE firms want to act very quickly. They're they have resources. They want to know if you're serious. And it doesn't really take them that long to go through your initial information in order to come up with an offer. So you could be looking at maybe from the time that they approach you to the time that they ask for your information, you send that to them. Once they have your information, they should be able to come up with a letter of intent within 2 to 3 weeks after that, because they want to move quickly. They're teed up and ready to go. They know what their LOI looks like, and there isn't much to it. They know their deal. You on the other hand are looking at this and saying, "Oh, I got to show this to my lawyer. I got to show it to my accountant.
Yeah.
I got to make sure I want to do this. I got to talk to my wife. I got to talk to my colleagues about and that's where, even though the letter of intent is not binding, once you sign that letter of intent, it is a flurry of activity.
Yeah.
You then go into actual due diligence, where they come in and really turn your place upside down, looking at everything possible. They have what's called the quality of earnings report quite often, which we do those types of things, and it really goes in and truly analyzes your revenue cycle and your contracts and your expenses. And it's, you can look at it as an audit, but it's way more detailed than an audit, because really when we're doing a quality of earnings report, we're telling the acquirer, hey, this is, these numbers are good, or these numbers have these issues. And that then becomes, a further discussion before the actual documents are drafted. If everything goes okay with the due diligence and the quality of earnings, then you're probably talking about another 2 months in that process, from the time you sign the LOI until the time that documents are actually being signed. So if, under an optimum level, this could be, 3 months, 4 months from start to finish
Got it.
until you get your check.
Okay.
And, it happens quickly. So be prepared.
In the deals, yeah, and furthermore, just working through, in addition to the things that you mentioned, working through the potential identity crisis of working for 14 years on this thing that you built, that you bled and sweat for, that you're now trading in for a W-2 wage, working for someone else. That's a process that you should give some consideration to, as taking some time and giving yourself time to process that, because that could be the
And
biggest part of this whole thing.
yeah, and bear in mind too, the PE firm wants to do these deals. They are selling you uh, to do this, because this is, they have to deploy the money that's been invested, and they want to do the deals, and that's why you see these larger and larger multiples and valuations arising,
Right.
because they're under a lot of pressure to find opportunities, and they want to do the deal. This isn't something where they're just kind of feeling you out. Once they look at your numbers, they know whether they're going to do this or not. And once they decide they want to do it, they are going to be putting a lot of pressure to get this done.
Are there any common pitfalls that you see in terms of doing the quality of earnings analysis, where a practice might get zapped more frequently than not on some sort of shortcoming or oversight in terms of their, their books, where there's a big gap then in the LOI? Like the PE firm said they're going to give you this multiple, but we came in, we looked around, we don't really like what we see, so now we're going to dock that multiple.
Well, absolutely. There's situations where if the quality of earnings is done and it's determined that you're not billing properly, if you're overbilling, if you're billing, fives, not fours, or threes, then that creates an issue. And then the PE firm looks at it and says, we still want to buy you, although that could create questions in their mind. But we know we're not going to get the money that you're presenting, or that's on your tax return or in your books. So we know that we're going to have to take a haircut on what we're valuing you at, and this deal may not work. So in many cases, when you're going through the quality of earnings and you're looking at expenses, there may be expenses that have been non-recurring, or that you're presenting to be non-recurring, and effectively increasing your valuation, because we call those normalization adjustments.
Right.
You may say, hey, those are non-recurring expenses. The PE firm says, oh no, they're recurring. In other words, you say, I don't need a practice manager anymore. And the PE firm says, oh no, you do. And your initial valuation assumed that you wouldn't need a practice manager. So all of a sudden that reduces the valuation.
Right.
To put it in extreme, and I know nobody on this call does this, but there are practices that when they get cash payments, they don't always report them on their income taxes. And they still expect to have that included in their valuation. And it's very difficult to do that. So again, not to cast any aspersions on people, but that does happen. And it does create problems in the valuation side. So those are all considerations that could take place that could create problems for the ultimate deal taking place.
Do you find that as long as the quality of earnings is reasonable or within kind of the expected boundaries, that there's not much gap between the LOI and the final deal in terms of
Yes,
value?
that's, yeah, absolutely. I find that when they do an LOI, they know what they're expecting. And when you sign that LOI, even though it's not binding, the PE firm wants those to be the terms. They don't want to change anything. They want the deal to go through. So they know what, they know how to make these things happen, and uh, there generally should not be a lot of gaps in what they're telling you, because they have a reputation as well. Think about it, that
Sure.
you go through this process, you pay your accountant, you pay your lawyer, you go through the LOI, you give them all this information, your staff is up in arms. You may not even want to be telling your staff you're selling. So it creates all these issues while you're going through this process. And then if they come back and say, we're changing the deal, then that's a bad reputation for them. And your
Yeah.
colleagues that they're talking to as well are going to hear about this. So they don't want their name on the street to have that associated with them. So
Yeah.
they want the deal to be done in accordance with the LOI.
Whenever you've seen deals fall apart, if you have with clients of yours, are there any, can you give us any sort of anecdotes of kind of what happened and things to look out for in that way?
Well, some of the things with the quality of earnings that take place are could create a deal to fall apart between the LOI and documentation. The LOI makes certain assumptions, obviously. So if somebody's overbilling, then that creates issues. Bear in mind, the seller never sees the quality of earnings report. It's done for the buyer. And so there may be things, actually in the quality of earnings that tells the buyer, I can actually bill more, I can make more money. So,
Right.
if the seller learns that and says, oh, okay, I've been underbilling, I should get more money for this practice. So they go back to the buyer and say, well, you know, we want more money and this and that. So that can create issues. After the fact, once you're part of the PE firm, I've seen things happen there as well, where the physician isn't performing. They've gotten their money, and they've decided again to take all their deferred vacation, and their mindset is different. And even
Right.
though they're trying to provide shares in the MSO as somewhat of a carrot and motivation, the physician all of a sudden says, "Okay, I'm done. I sold my practice." Well, no, you're still on the hook for 3 to 5 years in an employment agreement, but the mindset is I've sold my practice,
Right.
and that creates a lot of problems,
Yeah.
with the PE firm itself. And I've seen physicians, have uh, exit from the PE firm and find other opportunities, particularly if they're younger and they've sold. They'll exit because it just hasn't worked out, and then that becomes obviously a huge legal battle.
Sure. Yeah, so I think one thing I'm getting here is it might also make sense to do your own. If quality of earnings report belongs to the buyer, you're going to want to do your own due diligence and probably have some sort of billing audit done to verify it for yourself and see if you are leaving a bunch of money on the table because you're underbilling and that's being excluded from your valuation and it should be accounted for. You want to know that before you go ahead and sell that future income stream, right?
Right. It'd be, in preparation for all this, it may make sense to have someone come in and really look at your revenue cycle, because that's really where you're going to find, differences. And you want to know going in whether your revenue cycle is appropriate, meaning are you billing and collecting, effectively under the terms of your contracts? And are there ways that you could be, either capturing more money in the way that you're billing, because that will obviously lead into a greater valuation. Or if you're overbilling, then you don't want to run into those pitfalls either. So that's what I would recommend. The rest of the, on the expense side, pretty, pretty fairly straightforward. Your
Right.
your accountant should be able to come up with expenses that are both recurring and non-recurring when they're looking at your results of operations. Those
Yeah.
recurring and non-recurring expenses are very important, because those that you say are non-recurring, as I mentioned before, theoretically increase your valuation, and the PE firm may contend that those aren't really recurring, that non-recurring expenses, causes an issue with the valuation. So those are all things to think about when you're kind of going into this.
Awesome. Let's wrap it up there. Larry, this has been immensely helpful. I have learned a ton. I really appreciate your time today. If anybody out there wants to reach out to Larry, we're going to put his contact information in the show notes, apmsuccess.com/106. If you don't already subscribe to the YouTube channel, do that. You can watch Larry and I's talking heads bobbing back and forth instead of just listening on audio. Larry Elisco, thank you very much for joining us today on APM Success.
Thank you, Justin. It was really enjoyable as well. I thought your questions were great, and I'm always happy to discuss these things. And if anybody wants to call up and chat, I'm happy to do so.
If you liked what you heard this week, head on over to apmsuccess.com, where you can find more content and free resources to help you build a successful career in anesthesia and pain management. If you wanted to leave a review in iTunes, I'd also really appreciate it. Thanks for using some of your valuable time to join me today on APM Success.